But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Welcome back to an evening edition of the Junius Maltby channel. Tonight's topic, gold. We're going to look at several articles of the precious metal, and there are some interesting predictions and calls for gold, as well as some controversy between our old friend, the buzzer slapper, the animated character of CNBC, the cartoon character, Jim Cramer. So we'll talk about some things he had to say about gold. But first, let's check in on what gold and the little brother silver did today. Both of them coming down, what we'd consider a healthy pullback from what those highs were we saw earlier in the week. Gold dropping below the 1,500 mark. So it fell $11.70, down 0.75%, hanging out at $14.95.70. Silver at $17.50, dropping 3.7%, down 67 cents, falling below that $18 mark. Don't get too excited about it. As a matter of fact, buy some. Now, I've heard gold should be valued at approximately $10,000 per ounce based on the amount of it and the amount of fiat out there circulating on the planet. Here we see gold price should be $21,000 if you follow history. Rob McEwen. Now this is an article from Kitco from an interview with Rob. And we see here historically gold prices have climbed much more than what we have seen so far during bull rallies. And if we apply historical multiples, gold should be trading closer to the $8,000 to $21,000 an ounce price range. This, according to Rob McEwen, chairman of McEwen Mining. Gold from 1970 to 1980 went from $40 an ounce to $800 an ounce. So a 20 times move. And then it dropped to $250 in 1999 and 2001 and ran to $1,900 an ounce. That was a 7 times move. If you apply any one of those multiples to the lowest low we had recently of $1,050, you could see $8,000 to $21,000 price on gold, McEwen told Kitco News on the sidelines of the Precious Metals Summit in Beaver Creek. He might not be far off the mark. $8,000 obtainable. Yeah, a lot of people are probably laughing, scoffing, mocking, saying it's impossible. But then again, these are the perma bulls of the U.S. stock market that's denominated in the leper with the most fingers left, the U.S. dollar. These are the same people that are going to line up and buy 50-year treasury notes. The same people buying municipal bonds for cities across the United States facing bankruptcy, pension defaults, and nothing but red ink. Okay, so when you've got these investors saying that they're not going to buy gold because these numbers are impossible, just remember the indoctrination that they've endured for years, the schools they come from, and the choices they've made. These are the same people that ushered us into the financial crisis that said real estate could never, ever go down. And remember, gold is money. Everything else is just credit. It doesn't owe anyone, has no counterparty risk. It just exists. It's there. It's that permanent place to lock up your wealth, your work, your labor, to lock away your hours. It's that kinetic wealth we talk about, that store of value. It just protects that which you've worked so hard for. And it takes your wealth and locks it away from the ability of the financiers, the thieves, the bankers, the treasury, all of those who work in collusion to erode and inflate and destroy that which you've worked so very hard for. And it has served that role for over 65 centuries. So it's not going anywhere. It's not going to suddenly disappear or vanish from the planet. And human interaction with the precious metal will continue. And we're going to look at the central banks because they tend to point in the direction of where gold is going to go. And they are still buyers, and they are still very long gold. And you can see it in their behavior. And they've been long gold for over a decade. They've been gobbling up gold. We've been talking about it. We've been viewing it and sharing it here on the Junius Maltby channel. We've talked about the large purchases that took place during the last financial crisis, the number of central banks lining up to get huge stashes of gold. And not only that, a lot of the central banks calling it back home. Germany taking it back from foreign vaults. And they weren't the only one. A lot of countries lined up to take those central bank gold stores that they held overseas, and they want them held domestically. So when you see the repatriation of gold, when you see the central banks buying gold, it's telling us something, okay? And it's something we need to pay attention to. A lot of people might not be. They don't care. They might hear the information and ignore it. However, it's a telltale sign of what is en route to our financial position. Russia and China, they pop up all the time. We talked about them recently. We've talked about them in the past. Why Russian and Chinese central banks will keep buying gold. Russia's central bank gold reserves are now valued at more than 100 billion US dollars. Russian central bank gold reserves stand at 2,219.2 metric tons, according to the World Gold Council. Emerging markets have beefed up gold holdings, undeterred by prices near their highest levels in more than 6 years, as countries such as Russia and China diversify their foreign exchange reserves, a trend that is likely to continue. Central bank buying is, of course, important to the supply-demand dynamic for the metal, but is much more important in terms of sentiment toward the metal, says Brian Linden, editor of Gold Newsletter. When central banks are buying as heavily as they are, it provides cover and rationale for other central banks to do the same. Russian central bank gold reserves stand at 2,219.2 metric tons, according to the World Gold Council, based on the latest data available in September from sources including the International Monetary Fund. China's holdings are at 1,936.5 metric tons. I'm going to give some comedic relief here and include the United States gold reserves stand at 0 metric tons. Very likely, we don't know. Given the latest prices, with the most active gold futures contract down 0.78%, settling at $1,499.50 an ounce on Friday, and about 32,151 troy ounces in 1 metric ton. The value of Russia's gold reserves is at roughly 107 billion US dollars. The moves are due to concerns about the outlook for currencies, including the dollar and the euro, says Mark O'Byrne, research director at Goldcore in Dublin. While the gold tonnage demand from central banks in recent months has been significant and near records, gold remains a tiny fraction of most central banks' foreign exchange reserves, he says, adding that the trend is sustainable and indeed may accelerate. Pay attention to that last statement there. May accelerate. O'Byrne added that the risk of the trade war descending into a currency war may also be feeding central bank diversification into gold. Okay, hold on. Let's keep looking here. The rush of central bank gold buying doesn't say much about where near-term prices of gold are headed, but it does say a lot about where it's going over the long term, or at least where the banks believe it's going, London says. The banks always win. They're not going to be wrong on this call. There's a reason they are positioning on the giant financial chessboard by taking long positions in the ancient yellow metal, the barbarous relic the archaic money, gold, because it is money, and they see what's happening. It's all over the news, ladies and gentlemen. Trade wars, currency wars, potential shooting wars, currency debasement, inflation, hyperinflation, quakes and cracks showing and rearing their ugly head in nearly all marketplaces, ongoing debt, unsustainable debt, interest rates that are a joke, laughable. Gold is going to assist these major titans of the financial world weather the storm that is about to descend upon us. It is a hurricane of inflation, debt, destruction, and when it's done, when it passes through, and people survey the damages done, those who hold gold will be the equivalent of those who took out the proper insurance on their properties, those who prepared for the storm, those who fastened their windows with plywood, secured their property, and protected what they owned because they saw the weather reports. They saw the dark clouds on the horizon. They saw the barometric pressure dropping. They predicted the economic turmoil that was coming, and they prepared by positioning in gold. Now, we're going to move on, but I want you to, if you're still here, I know this is the most boring channel on YouTube. A lot of you, I can tell, because I look at the analytics. I know some of you watch a couple minutes and then you bounce, and that's okay. You missed the meat and potatoes, and I like to save the best for the last, for the dedicated few that actually stick around and watch these videos in the duration for all of the information, because there's stuff coming up that's pretty valuable. So we got the clown, Cramer, at odds with Citigroup. So gold prices, Cramer and Citigroup at odds about the upside. Gold has been one asset benefiting from the ongoing U.S.-China trade war. However, there are various opinions on its outlook. Some observers, such as Jim Cramer and Citigroup, disagree on what's in store for gold. Now remember, Jim Cramer's the guy that was screaming from the rooftops to buy Bear Stearns literally the day, hours before its complete implosion and collapse. This is a guy that said Bear Stearns could not collapse. It was immovable. And the guy was buying it. He was telling people to buy it on his show. And the next day, it went to zero, disappeared, vanished from the spectrum of the financial world. You couldn't have bought it if you wanted to. It didn't exist. It was zero. It was gone. Whew. Boom. Smoke. Vapor. Vanished with people's wealth. So, Jim Cramer, whatever. We don't know who listens to this guy anymore. Do people actually log on or watch CNBC Fast Money and pay attention to this entertainer, this guy that slaps buzzers and rings bells and honks horns and jumps around and screams with his sleeves rolled up and his roughed up tie and his sweating bald forehead? I don't know. I don't know who takes all of their financial advice from Jim Cramer. It's interesting. It is interesting that Americans will literally eat anything off of a spoon that comes out of their television. Citigroup sees gold soaring to $2,000 per ounce. We covered this last week, the Citigroup long call for gold. As reported by Fox Business, Citigroup analysts believe gold could reach a record high of $2,000 per ounce within the next 2 years. Their forecast, as reported by Fox, is based on their views on the lower interest rates, rising geopolitical risks, such a gentle term, geopolitical risks, U.S.-China trade war, and rising gold demand. Gold's last peak was seen in September 2011 when it reached $1,921 per ounce. Ladies and gentlemen, when it touches $1,921 again, it's probably going to be for only a few minutes because it's going to blow past that. We are going to see $2,000 gold. It will happen. It will happen with a far greater chance than any of those calls you see of it dipping below 1,000. Again, I made that call recently here on the channel. I don't like to make, hardcore, steadfast calls where I'm saying a value will occur, and I don't like to give time frames either. But I am very confident that we will not see gold, and I've always held by that, below that 1,100 mark, based on the central bank behavior. If you have been a member and participant in this channel for some time, You're very familiar with the large central bank purchases, and we specifically name India back in the last crisis and the amount of gold that they took positions in during that time and at what valuations. I believe it was around 11 or 1200, 11, might have been 1120, 1150, that they made those large 220-ton purchases, something of that nature. Again, I'm just going off of memory here, but that is one of the main reasons. You looked at the purchases India made as well as a list of other central banks, and again, we just covered an article that talked about central bank actions on gold showing where it would be in the future. And if you look at today, and then you look at the behavior of central banks 10 years ago, you can see very clearly why gold has not dipped to at or below the levels that they purchased at. They didn't make a mistake. They knew what they were doing. They're long gold. They've been long gold for over a decade. So you should be also. Jim Cramer sees gold prices coming down. In contrast to Citigroup, CNBC's Jim Cramer is skeptical regarding gold's upside potential. On September 10th, he said, quote, "For months, investors have been moving their money into safe haven assets like treasury bonds and gold," he added, "but they've now run up dramatically, and the charts, as interpreted by the always astute Carly Garner, suggests that it's time for both bond prices and gold prices to come down, or perhaps come down hard," unquote. Garner is an analyst and co-founder of DeCarly Trading. Cramer often refers to her work for his analysis. I wonder if she also told people to buy Bear Stearns. I wonder. I don't know. We'd have to look her up. I disagree with Cramer, and so does Citigroup. Now, this is news to me, and I'll tell you what part of this is news to me. Can gold help diversify a portfolio? Gold has had a great run this year, but it's always had a questionable reputation among many money managers because of its volatility and difficulty in valuing. I disagree with a lot of that statement. Now, Investment News cites a study showing that a 5% allocation to the yellow metal improves the risk-adjusted performance of a standard portfolio of 60% stocks and 40% bonds. Now, I'll show you what part of this article surprised me and caught my attention. For optimal risk-adjusted performance, as measured by the Sharpe ratio, the standard 60-40 portfolio should be set at 60% stocks, 5% bonds, and 35% gold, according to Granite Shares Research. Do you see that? 60 stocks, 5% bonds, and 35% gold. I've never seen any article where any financial institution recommended 35% gold holdings for a portfolio. Absolutely mind-blowing, surprising. And again, this is something that should point to the future long for gold. If firms such as Granite Shares are talking about 35% positions for normal everyday portfolios, I mean, they're talking about the portfolios for the guys that are out like golfing. You know who I'm talking about. The boomers. The guy that's maybe about to retire, recently retired. The individuals that really don't have a whole lot of financial worry. They're out there driving their 1 or 2-year-old $60,000, $70,000, $80,000 car. They've got some real estate holdings. They're comfortable. They're probably a little out of shape. They travel frequently. And they're sitting on a portfolio. And they're telling them to have 35% positions in gold. Most of them do not. Most of them have little to no gold holdings. And I can almost guarantee you less than 1% of any of these individuals hold any physical gold whatsoever. Most of them are going to be holding gold on paper or part of a portfolio, and it's going to be, in an ETF. It's going to be locked up someplace. They'll never see it, never hold it, and they don't even know what gold really looks like. They wouldn't know a gold eagle if you showed it to them. If you saw a large segment of the population that has income to invest and position in gold, and they started to move it in that direction to where we saw 35% positions in a lot or a majority of the portfolios, you would see a large demand drive towards gold and a further increase in price just on the investment side for the everyday citizen, the average investor. Obviously, if central banks really can purchase much larger quantities of gold, driving that price further. However, the people of India, they're the largest holders of gold outside of the central bank arena because they purchase and invest in it heavily. It's one of their, I would say that their portfolios are 60, 70, 80% gold or more further. You've also got Southeast Asia. A lot of the Southeast Asia countries, huge buyers of gold immediately upon payday. It's traditional, it's cultural. They know, they've experienced currency debasement, and they've seen historically the long-term value in holding positions in gold. Adding gold to a portfolio improves the Sharpe ratio, and a 35% allocation is optimal, said Will Rind, founder and chief executive of Granite Shares, an ETF provider whose funds include the Granite Shares Gold Trust, ETF BAR. Rind adds, gold has more value in a portfolio than most people think. Hold gold. Global currency debasement looms. BlackRock. The chief investment officer of the world's largest asset management firm is recommending investors to hold some gold to protect themselves if central banks introduce aggressive monetary policy easing policies. In a commentary published last week, Rick Ryder, chief investment officer of BlackRock, said that central bank action around the world has done little so far to push inflation back to 2% inflation targets. He added that if central banks want to achieve that goal, they are going to have to get a lot more aggressive, which means sovereign debt yields will fall further into negative territory. Ryder said that market forces to push inflation have become ineffective because in the new digital age, consumers have instant access to market inflation. By definition, the worst asset to hold would be a sovereign bond with a negative yield, closely followed by paper money at zero yield. Both was a theoretically infinite supply, he said. Warren Buffett would agree with that statement. The worst thing you can possibly hold on this planet is dollars. If you're sitting on a pile of cash, if you have bank accounts stuffed with Federal Reserve notes, 100, 200, 1,000 US dollars just sitting there, it's basically on fire. You are losing wealth, purchasing power, and the ability to maintain dynastic wealth in the long term. Right now, it's rotting. You might as well go into the bank, douse the vault with kerosene, and light your own money on fire. It is the absolute worst thing you can do. It is also the most dangerous thing you can do. Anything is better. Anything. Crypto would be better than just sitting on dollars. Put that stuff to work. If it's real estate, rentals, anything, gold, lock it up. Especially the environment we are entering right now with what you see in the news. If you don't see it, oh, it's going to be too late for you by the time you do. Although currency debasement will boost inflation, Ryder also warned that these policies would have some significant consequences, like inflating real asset prices and widen the wealth gap, which would fuel more populist governments. BlackRock has consistently looked for lower U.S. bond yields as the Federal Reserve looks to start a new easing cycle as early as next week. I love when I'm reading these articles and I catch grammatical errors like looking. They should not have put the word looking in there. It should be look. In an interview with Kitco News in late June, Joyce Choi, Director of Fixed Income Product Strategy at BlackRock, said that she expects to see U.S. 10-year bonds yield push below 2% as the Federal Reserve cuts interest rates by 50 basis points this year. We do expect 1 or 2 rate cuts in the next few months, so that would actually indicate that we should see 10 years start falling lower, she said. The bias is towards bond yields given the inflation expectations. Again, let's summarize what we've discussed this evening, then we'll close it out. You guys can jump into the comments and hash it out in the mosh pit of words that is known as the YouTube comments section. Central banks are buying gold. They're net buyers. Everywhere you look, there are signs that the U.S. and the global economy are faltering. Europe's got problems. The U.S. has problems. There's trade wars. There's currency wars. the list goes on. And amidst all of this, we're seeing more and more moves towards gold. Not only from the central bank side, but from the average investor side. It's being talked about, it's being discussed, it's being looked upon as favorable. Of course, you have some that disagree with it still. They always will. They hate it for more ideological reasons rather than for any logical reason whatsoever. They just hate it because, well, they've been indoctrinated to. However, those of you, if you're here on this channel, are most likely not in that camp. Most of you are holders of both gold and silver and are doing the right thing and the good thing to preserve dynastic wealth going into the future. So that's a good move. You're making the right decision, the right choice. And videos such as this serve more as a motivational kick in the pants for you. A little tap on the back saying, good job, keep it up. Keep your chin up. Even on days where the price dips a little bit, a percent here or there. Long term, overall, you know where it's headed, you know what's coming. And be confident in holding gold. Continue to be confident. And don't let, old Uncle Jim or Daryl at the holiday dinner table shake you and make you scared of your position or make you think you're stupid. You're not a gold bug. You're a gold hawk. And you're the toughest, strongest guy in the room. Yes, there is a wealth transfer, a shift, a paradigm that is going to swing and change, a pendulum swing, one direction to the other. We're going to witness it in our lifetime. That is, if I live, a few more years. We're going to see it happen. So just buckle up, buckle in, prepare for it, and be confident. That's what it takes, confidence. Invest, buy the lie, because these people are lying to us every single day. Don't do what everyone else is doing. Go the opposite direction. Be the Dr. Michael Burry. Be the one that everyone's telling is wrong. But in the end, you end up being right. Alright, thanks for being part of the Junius Maltby channel. Smash the like button. Give me a thumbs up if you like the content here. If you want to support the channel, there's links for that. They're down below. You could always use a little bit of support, a little bit of Patreon help, a little bit of, the crypto links that are down there. I do use that to take certain positions in certain crypto, as well as move it later on if I can. It's been a rough year for me. I'm glad to be back. Glad to be sitting here talking to you guys and putting out content. It's good. It is good. So, hopefully we can do some non-metal related videos as well later on, in the springtime, show you the garden, talk about trees, talk about fruits, talk about vegetables, talk about real things. Maybe go out on a hike or two, a couple adventures, do some footage there, show you some beautiful places, some beautiful things. Because life is not all about just money and wealth preservation. It's about enjoying our loved ones, enjoying the great outdoors, enjoying life in general. Alright, there you have it. Another installment of the Junius Maltby channel. Wrap it up.